Gold and silver just did something that almost never happens quietly. They outran the S&P 500 in real time, right in front of everyone, and the market is still pretending it's just a safe haven headline. It isn't. This move has a mechanical engine under it, and if you understand that engine, you'll know what matters next week, what level turns this into a full-blown squeeze, and what would actually invalidate the whole thesis. And here's the part most people are missing. The calendar is the catalyst, not the commentary. Let's start with the scoreboard because it's the one thing nobody can spin. In late January 2026, gold pushed through the $5,000 line and printed fresh highs above it, while the S&P 500 has been churning with only modest gains month to date. Silver didn't just follow, it accelerated, tagging triple digits after starting the month down in the low 70s. That spread between paper prosperity and hard asset urgency is the tell. And the tell gets louder when it happens this fast. Now watch the psychological trick that always shows up at moments like this. The moment metals rip, the narrative machine tries to file it under one of two neat boxes. Either panic or mania. Panic means it'll fade. Mania means it's dumb money and it'll collapse. Both stories do the same job. They discourage you from looking at the mechanism. Because once you look at the mechanism, you realize something uncomfortable. This is not just a mood swing. It's a repricing of trust. And trust reprices in bursts. So what's the conflict? The conflict is that a sustained metals breakout is not a cute side trade. It's a warning label on government bonds, a stress test on currencies, and a mirror held up to equity valuations. If gold can sprint while equities tread water, it's telling you capital is hedging something bigger than earnings. And that's where the real pressure starts. Here, it's the hidden detail that reframes the whole story. Options, expiration, and dealer hedging around major round number strikes. Right now, the market is colliding with a specific window where gold options tied to near-term contract months hit last trade and settlement dates. That matters, because options aren't opinions, they're obligations. And when enough of those obligations cluster around a level like $5,000 in gold or $100 in silver, price doesn't just discover itself. Price gets pushed, pulled, pinned, and then released. The next detail is what flips the whole setup. Most people think options are just side bets. They're not. Options are a transfer of convexity. When traders load up on calls, the other side of that trade is often a dealer who is not trying to be a hero. The dealer is trying to be flat, and being flat means hedging. If price rises toward a wall of call strikes, the dealer may need to buy the underlying to stay hedged. That buying is not emotional, it's math. And when the market is thin, when liquidity is patchy, when books are cautious, when everyone's watching the same levels, dealer hedging can turn into forced buying. That's how you get those "it won't stop" candles. But that's not the part that matters. The part that matters is what happens after the level breaks. Round numbers aren't mystical. They're where open interest stacks, where stops cluster, where margin calls trigger, and where systematic strategies flip signals. A clean push through $5,000 in gold isn't just a headline. It's a line in the sand for risk managers. It's where shorts, who were comfortable, become shorts, who are sweating. And when shorts sweat, they don't reassess. They cover, they buy, and that buying can be violent. Now layer in the calendar trigger. Late January isn't just another week. It's a convergence of expirations, month-end positioning, and the kind of liquidity conditions where a big move can gap on you. Funds rebalance. Dealers roll risk. Liquidity providers widen spreads when volatility rises. And if you've ever watched a market go from orderly to chaotic in an afternoon, you already know why this matters. In transition windows, price discovery gets sloppy. Sloppy price discovery is where squeezes are born. And if this one level breaks, the math changes. Let's zoom out and make it finance real, not vibes. The reason gold ripping while the S&P stalls matters is because it hints at a different regime. In the old story, rising real rates were supposed to crush gold. In the old story, equities were the only game in town. In the old story, bonds stabilized portfolios. But regimes end when the assumptions underneath them stop working. And lately, the bond market has been sending a message with a clenched jaw. Higher yields aren't calming anyone. They're scaring people because higher yields with fiscal anxiety aren't opportunity. They're a flashing light that says the cost of financing is rising and the debt is not shrinking. That's the setup where gold stops behaving like a commodity and starts behaving like insurance. Now, proof, stack time, because you don't get to claim a new regime off one chart. First proof point is relative performance itself. Gold pushing into record territory while a major equity index is basically grinding. That divergence is rare. Second proof point is silver's torque. Silver is the higher beta cousin, more volatile, thinner, more prone to air pockets. When silver moves this hard, it often means the market isn't just hedging, it's scrambling. Third proof point is the currency tape, especially the yen story. When the yen strengthens sharply and the dollar wobbles, it changes the global pricing of commodities, and it signals stress in the global bond complex. Fourth proof point is behavior in the derivatives layer. Clustering around $5,000 and $100 is not subtle, and the way price behaves near those levels often screams gamma. Fifth proof point is the physical conversation. Premiums, delivery urgency, and procurement behavior tend to show strain when paper rallies are backed by real demand. And we can stack more because we should. Here's a sixth proof point that traders underestimate: the term structure. Spot is the headline. The curve is the confession. In a normal, well-supplied market, carrying inventory costs money, and futures prices reflect storage, insurance, financing, and convenience yield. When the market gets tight near term, you can see it in spreads, in nearby strength, and the way the front end refuses to relax, even when you get a dip. You don't need exact inventory numbers to understand the logic. If nearby delivery becomes more valuable than future delivery, that's what stress looks like in market structure, and that's where the real pressure starts. Now, let's talk about paper versus physical without turning it into a cartoon. Markets are not a single monolith, they're layers. Futures markets are phenomenal for price discovery and liquidity, but they also allow huge notional exposures with relatively little capital. That's not evil, that's how leverage works. But when a leveraged layer starts pushing hard into a physical constraint, when delivery windows, refining capacity, and logistical lead times become the bottleneck, the relationship between paper price and physical reality can get tense. Not always, not every time, but when it happens, it tends to happen fast. The next detail is what flips the whole setup. Silver, in particular, has a unique vulnerability here because it's not just money-metal psychology. Silver is a hybrid. It's monetary hedging and industrial input at the same time. That means it can get hit with two kinds of demand at once: investment demand that spikes during uncertainty, and industrial procurement that doesn't care about narratives because production schedules don't pause. If you're a manufacturer and you need metal, you don't get to wait for a better entry. If your supply chain is on the line, you lock in, you hedge, you pay up. And that behavior doesn't show up first on Twitter. It shows up in spreads, in forward buying, in the quiet urgency of procurement. Now let's pin down why silver supply doesn't just magically respond to price. This is the part that gets people into trouble when they assume high price equals high supply. A lot of silver is mined as a byproduct of base metals. That means silver production is often a passenger in the car, not the driver. If copper, lead, zinc operations aren't expanding, silver can't just ramp at will. Add refining bottlenecks, add permitting timelines, add the reality that building capacity isn't a weekend project, and you get a supply curve that is stubborn. Stubborn supply plus spiky demand equals outsized moves. That's not drama, that's economics with a fuse. Now you might be thinking, okay, but why would gold and silver outrun the S&P right now specifically? The answer is that right now is the intersection of macro stress, positioning, and calendar. Macro stress is the background hum: fiscal concerns, geopolitical noise, currency instability, and bond market discomfort. Positioning is the accelerant. When too many participants are leaning the wrong way, the unwind becomes fuel. And calendar is the match: expirations, month-end flows, and liquidity conditions that amplify the effects. Put those three together, and price can move in a way that feels like a trap. Because it is a trap for the wrong side. Let's make dealer hedging vivid, because once you see it, you stop being confused by the whipsaws. Imagine prices climbing into a wall of call strikes. Traders are long calls, feeling clever. Dealers are short those calls, not feeling anything except risk. As price rises, the delta of those calls increases, meaning the dealer's short exposure effectively grows. To hedge, the dealer buys the underlying. That buying pushes price higher, which increases delta further, which forces more hedging. That feedback loop is the reflexivity spine of a gamma-driven move, but it's not permanent. If price stalls, gamma can flip. If price drops away from the strike cluster, dealers may unwind hedges, which can accelerate the drop. That's why you can get a violent dip even inside a strong trend. And that's where the real pressure starts. This is also why the mainstream manipulation framing is usually unhelpful. The market doesn't need a villain to do villain-like things. Incentives and structure are enough. If your job is to manage risk, you will behave in ways that look predatory to outsiders. You will pull liquidity when volatility spikes. You will hedge aggressively near levels that threaten you. You will trigger stops if it reduces your exposure. None of that requires a secret meeting. It requires a risk committee and a mandate. The hidden mechanism isn't a conspiracy, it's the plumbing. Now, institutional flows. This is where a lot of retail investors either get cynical or get hypnotized. The truth is less dramatic and more powerful. Big money moves in slow rivers until it doesn't matter what you saw it. When a narrative shifts from gold is dead money to gold is portfolio insurance again, reallocation doesn't happen via one heroic trade. It happens via policy portfolios, via risk parity adjustments, via sovereign reserve decisions, via pension hedges, and central banks have been a persistent buyer in the broader backdrop of the last couple of years, not because they're guessing charts, but because reserve diversification is a strategic behavior. You don't have to pretend you know the exact daily flow to see the direction of the wind. When trust in paper gets questioned, metal becomes a collateral of confidence. And then there's the bonds are supposed to hedge problem. In a lot of portfolios, bonds are the shock absorber. But if the shock absorber is leaking, if yields rise because credibility is questioned, then the old playbook breaks. That's when investors look for a different hedge. Gold is the ancient hedge, but it's also the modern one because it doesn't have a default risk. It's not a promise, it's a thing. And when the market gets nervous about promises, things outperform. Now let's bring in the global comparison angle because it's not just a US story. Currency moves matter because they influence global purchasing power. If the dollar weakens and the yen strengthens, that doesn't just change the translated price of gold. It changes the behavior of global capital. It shifts hedging demand. It impacts carry trades. And when carry trades unwind, you can see risk ripple across assets that seem unrelated at first glance. That's why precious metals can move on days when equities look sleepy. Different layers are moving. Different pressures are releasing. And that's not the part that matters. The part that matters is what happens next week when the market has to prove it. Breakouts are easy. Retests are the test. A breakout can happen on thin liquidity and forced flows. A retest tells you whether real buyers exist at higher levels. It tells you whether the market is building a higher base or just printing a blow-off top. And it tells you where the stress line sits for the people who can afford to be wrong. So let's talk levels, not as prophecy, but as risk framework. For gold, $5,000 is the obvious pivot because it's a psychological level and a structural one. If gold holds above it on a pullback, if it dips toward it and buyers show up, if the market refuses to spend time below it, that's confirmation behavior. If gold slices back below $5,000 and can't reclaim it, that's not the end of the world, but it shifts the near-term risk toward a deeper retrace into the prior consolidation zone, the kind of move that shakes out late longs and resets positioning. A clean weekly close above that pivot is the kind of thing that forces portfolio managers to stop dismissing the move. And when managers stop dismissing, allocations start changing. That's where the real pressure starts. For silver, $100 is the pivot for the same reason, but with more volatility attached. Silver doesn't do gentle. If silver holds near triple digits and then grinds higher, that's a strong signal of sustained demand. If silver loses $100 and drops quickly into the mid to high 90s, that can still be constructive if it stabilizes and reclaims. What you don't want, if you're bullish, is a deep flush that breaks multiple support layers and then fails to bounce. That would suggest the move was mostly mechanical and not yet supported by deeper buying. But remember, even a bullish thesis can be correct while price punishes you. That's the lesson most people refuse to learn, right until the market teaches it to them. Now, let's address the biggest counterpoint, because it's the one that blows up credibility if you ignore it. Parabolic moves invite mean reversion. They attract fast money, they create crowded longs, they tempt late buyers to chase, and the market loves to punish chasing. Gold and silver can absolutely whip around violently, even if the bigger trend is up. That's not a bug. That's how markets transfer money from impatient hands to disciplined hands. If your plan depends on a straight line, you don't have a plan. You have a wish. And wishes get margin called. So here's the viewer psychology shield, the part that keeps you from becoming exit liquidity. Step 1 is separating trend signal from noise. Trend signal is the break and hold of key levels, the behavior on retests, the persistence of strength across multiple sessions, and the way the market reacts to bad news. Noise is intraday spikes, headline-induced whips, and the emotional nausea that makes you click buttons you didn't plan. Step 2 is understanding the emotional manipulation of volatility. The market will try to make you feel late at the top and doomed at the bottom. It will put you in a state where your only goal becomes relief. Relief is expensive. The way you protect yourself is by deciding in advance what would confirm your view and what would invalidate it. Then you stop negotiating with your emotions in the middle of the storm, because that's where the real pressure starts. Now, let's build a clean 2 scenario lens for the next 1 to 2 weeks, because it keeps you honest. Scenario 1 is the controlled pullback and retest. In that scenario, gold cools off, dips toward the breakout area, and finds buyers around the pivot. Silver cools off too, maybe retraces a chunk of the sprint, then stabilizes and rebuilds. Volatility may compress a bit. The market gives you time. This is the scenario where patience gets rewarded. Confirmation looks like higher lows, quick reclaim of key levels after dips, and resilience during risk-off headlines. Invalidation looks like repeated failures at the pivot, weak bounces that get sold, and a shift where rallies start feeling heavy instead of powerful. Scenario 2 is the continuation squeeze. In that scenario, the market doesn't give you the polite pullback. It keeps pressing higher because positioning is still wrong-footed, because hedging is still chasing, because liquidity is still thin, and because shorts are still forced to cover into strength. This is the scenario with gap risk. It's the scenario where you wake up and the market is already a different price. Confirmation looks like relentless bid behavior, shallow pullbacks that get snapped up, and a tape that refuses to let late bears breathe. Invalidation looks like an abrupt reversal that breaks below the prior day S range, and then fails to recover, especially if it happens around the post-expiration window when hedges can unwind. The next detail is what flips the whole setup. Now, let's talk about what to watch besides price, because if you only watch price, you're always late. 1. Watch volatility behavior. When metals are in a healthy uptrend, you can still see volatility, but the dips tend to be bought and the rebounds tend to be cleaner. When a blow-off is forming, volatility becomes chaotic and reversals become sharper. 2. Watch the dollar and the yen relationship, because currency stress is often the spark for cross-asset hedging. 3. Watch how equities behave on days when metals are strong. If equities sell off while metals rally, that's classic safe haven behavior. If equities rally too and metals rally, that can indicate broader liquidity and inflation expectations shifting, which is a different flavor of bullish. 4. Watch the curve and spreads where you can. If nearby tightness persists, it supports the idea that this isn't just a speculative puff. 5. Watch narrative whiplash. When the narrative flips from gold is irrational to gold is obvious, you're often closer to a consolidation phase. Not necessarily a top, but a digestion. And digestion is where impatient traders get chewed up. Also, watch the behavior of retail availability and premiums, not because retail is the whole market, but because it's a thermometer. When retail availability tightens and premiums widen, it often reflects a surge in demand at the edges. Sometimes that edge demand is noise. Sometimes it's the first wave of a broader reallocation. The trick is not to worship any single metric. The trick is stacking them. Mechanism, then behavior, then confirmation, then risk framework. That's how you build trust with yourself. Now I want to address the institutional skeptic in the room, because I know you're here. You're thinking, fine, but why would the system allow metals to scream like this? The answer is, the system doesn't allow anything. The system is a collection of participants managing exposure under constraints. If constraints tighten, outcomes change. If bond markets are volatile, hedges shift. If currency credibility is questioned, stores of value become more attractive. If political risk rises, portfolios seek ballast. And if derivatives positioning is lopsided, the unwind can overpower narrative control. The market doesn't need permission. It needs imbalance. That's the part that matters. So what comes next, practically, for someone who wants to be finance literate and not emotionally farmed? You treat $5,000 in gold and $100 in silver as key pivots, not as magical targets. You pay attention to the first real retest. You accept that violent pullbacks can happen even in a bull trend, and you don't let a single red candle rewrite your whole thesis. You respect that the market can punish both bears and bulls in the same week, and you focus on structure. If gold holds above the pivot and silver rebuilds above its pivot, the path of least resistance stays up, and the next push can come faster than people expect. If those pivots fail and price can't reclaim them, you shift to defense and wait for a cleaner base. That's not being scared, that's being professional. And here's a final warning, the quiet one that saves accounts. If this move is real, volatility will be used against you. You'll see days where the market rips in the morning and dumps by the close. You'll see headlines timed perfectly with thin liquidity. You'll see obvious tops that get obliterated and obvious breakdowns that reverse violently. The goal is to make you reactive. The antidote is to be systematic. Decide what you're watching. Decide what changes your mind. Size accordingly. And don't confuse intensity with certainty. One more thing before we close the loop. The reason gold and silver outrunning the S&P matters is not because it guarantees anything. It matters because it signals that a different kind of buyer is stepping in, a buyer who's less sensitive to valuation and more sensitive to trust. And when trust is the variable, markets can move in discontinuous jumps. And if the next week lines up with the same calendar pressures, expirations, month-end flows, thin liquidity, you don't get to assume this is over just because you want it to be calmer. Calm is not guaranteed, but clarity is available if you watch the right things. If you're the kind of investor who'd rather understand mechanisms than memorize narratives, you're already ahead of the crowd. Stay in that lane. Compare notes with people who respect risk. Keep your checklist tight, pivots, retests, currency stress, volatility behavior, and whether the market is buying dips or selling rallies. That awesome yes, how you stay on the right side of a regime shift without letting the market turn your nervous system into a trading signal. And if you want to keep doing this the right way, fast, evidence first, skeptical of easy stories, stick around and stay plugged into the community that cares about the plumbing, not the propaganda. Because when the next move hits, it won't feel polite. It'll feel sudden. And that's where the real pressure starts.